Hey guys, John Swain here from We Love Small Business, and in case you're wondering where I've been over the past few months, I've been buried in personal and corporate tax returns. Oh, and let's not forget about those silly bear trust rules that the government canceled a few days before the deadline. Anyway, I'm out of the hole and I'm ready to get back on the video horse. So today, we're diving into one of the most talked about changes in Canada's brand new budget, the capital gains tax. So this topic has stirred up a lot of controversy, so I'm going to do my best to break it down in a way that's easy to understand. First, let's quickly review what capital gains tax is and how it works. So unlike income tax, which is applied to your earnings, capital gains tax is applied to the profit you make when you sell an investment. And this could be stocks, bonds, real estate, that kind of stuff. So say if you bought an investment for $50,000 and sold it later for $100,000, you made a capital gain of 50 grand. Now before this latest budget release, you only had to report 50% of that gain, or 25K. And that's called the inclusion rate, right? 50% is included, 50% not. And you will pay tax on 50% of the gain. But stay tuned, there's changes, and not for the better, I'm afraid. Now, before I go on, you're here anyway, so can you hit that thumbs up and subscribe to the channel if you haven't already. I do these videos purely for the love I have for small business owners. I don't get paid any money for this channel, but liking and subscribing is what helps me get videos like this and many, many more small business friendly videos out to the folks that really need help. And that, my friends, is payment enough for me. Okay, so back to capital gains. So for individuals, the government plans to change this inclusion rate. Instead of the 50% inclusion rate I just mentioned, the new budget increases the inclusion rate to 66.67%, or 2/3, for annual capital gains above 250K. So again, the first 250K of the capital gain is only 50% to be reported, but over and above that will require 2/3 versus the 50%. And this higher inclusion rate means higher taxes. The higher the inclusion rate means higher taxes. Bummer. But that's just for individuals. Corporations will also be hit with this increased inclusion rate of 66.67% on all capital gains, not just the gains over the 250K. Double bummer, especially for folks with holding companies. And by the way, just a quick commentary on this. Our Prime Minister acts like these increases are meant to tax the ultra rich. But that's horse crap. I've made a career serving small business owners who don't have pensions and other safety nets that the regular Joes we all see in the Tim Horton lineups every morning have. They have saved money all their careers to create their own nest egg. And contrary to popular belief, the capital in these companies will generate incomes no different than a government employee or any other middle-class career employee with a pension will earn. So generally speaking, that is. So don't fall for this bill of sale this Prime Minister's telling you to make it seem like they're merely taking a little more from the rich to help the middle class and those who wish to join it. Small business owners are as much the middle class as employees are. There's rich ones, there's some poor ones, but the vast majority are just hard-working stiffs like you and me. You and me. I'm in those lineups too, Mr. Man. Now this crap is insulting to yours and my intelligence. Okay, so what can folks do to plan for this capital gains change? Number one, evaluate your investment timing. Consider the timing of selling investments. If you anticipate significant capital gains, selling before the new inclusion rate takes effect could save you a considerable amount of taxes. For instance, selling before June 2024 can help you avoid the higher inclusion rate. Number two, maximize the tax advantage accounts like the tax-free savings account and registered retirement savings plans, RRSPs. Gains within these accounts are either tax-free, TFSA, or only taxed upon withdrawal as income, like the RRSP. It avoids the higher capital gains tax altogether. And number three, review corporate structures. For business owners, particularly those with investments held within corporations, reassessing how investments are structured and timed can be crucial. So discussing with a financial advisor and your CPA might reveal strategies to minimize the impact, but especially if you're contemplating triggering some sales within your corporation. There are some very important elections that can be made prior to incurring any capital losses that should be dealt with prior to triggering those losses. I'm not going to get too deep into it right now because it's technical, but it involves a special dividend called a capital dividend. And it could be tricky, but drop that name capital dividend in the conversation with your CPA and they'll know just how to advise you. Number 4, consider real estate sales. Now, there might not be enough time to do this, but if you own properties that have appreciated significantly, selling before the new rules come into effect could prevent a substantial tax hit. This is particularly relevant for secondary properties like rental properties or cottages. Again, crunch numbers with your CPA. You don't want to cut off your nose to spite your face and sell something in haste at a tax fear. Remember, we very well could have a change in government soon, and perhaps the new government can reverse the multiple sins of this current government. That's a tall order, but even if half of them were reversed, we'd be in much better shape going forward, believe me. And lastly, if you can't beat the clock on these new rules, consider reinvesting your gains. And there's ways to defer taxes, such as through certain types of reinvestment plans or rollovers, which may have tax deferral benefits. Again, talk to your CPA. Now, if you need a CPA and you'd like a second look at things, I'd love to chat, but here's the deal with me. You gotta be a small business owner. There's a reason why we named this channel We Love Small Business. We are designed to rock the world of small business owners, but if you don't have a business, coming to us is like taking a bazooka to a plastic knife fight. Capiche? Okay, until the next harebrained scheme the government puts us through, remember, small business owners, there is someone in your corner. Till next time.